Robschild, no investment advice. Welcome to the show where we view financial markets through crystal ball gazing. Today is Monday, September 16th, 2024. Today's episode will start by talking about the Fed funds futures flipping to a 50 basis point cut for this meeting coming up in 2 days. It has been for a while where we were priced to have only one 25 basis point cut, and then on Friday we switched to 50-50, and I'm not sure what happened over the weekend, but it seems that the market is now believing that the Fed is believing that they may be further behind on the cuts than they thought they were. And if you've been listening to other people talk about this, some people have been mentioning how starting with a 50 basis point cut is sending a signal from the Fed to the market saying, hey, actually, we're behind this thing. We need to catch up now. And so I find that to be very interesting, especially because there was no major news coming out. We didn't have any new CPI reports or anything really. If anything, the consumer sentiment report on Friday was stronger, which indicates to me that it would make more sense for the 25 basis point cut. But then we went to 50-50, and now today we're looking at a 0.5% cut here. So very interesting. All in all, though, looking further out on the Fed funds futures, we can see that we're still looking at, one double cut and then a single cut and then another double cut and then single cuts beyond there. Oh, look at this, another double cut actually. Okay, so we're looking at more cuts sooner actually, which is interesting. So as I've been saying before, I found it to be very interesting how the market kept pricing in the first cut being 8 months away, and they kept pushing it out. No, it's still 8 months away. The next month, still 8 months away. We kept pushing it out and out and out. And again, I think this does have to do with the fiscal dominant situation. When you have a government with an enormous amount of debt, a lot more debt than it's had for a long time, the actions of the Federal Reserve on monetary policy are less effective. And so the market kept expecting the hikes to be more effective than they were, and so it kept getting pushed out. And again, it seems like we might be on the other side of that coin, and it seems like there might be evidence now showing that that perspective is actually correct here, that we may be seeing closer, stronger cuts going into the future that continuously have less of an effect than what the market is expecting, which is how I've been expecting this to play out for a while now. The Federal Reserve typically does what the market prices, and so the decision is on Wednesday. I can't really imagine it flipping back to a 25 basis point cut for the first cut at this point, being Monday, 2 days before this decision is released. But we'll see what happens. Wednesday will be a very, very interesting day, a historic day. This is the first cut of this cycle. Last main thing about today's episode, I just wanted to mention about rate cuts and how, the whole point of cutting rates is to make money cheaper to borrow so businesses can, more easily make more money so they can hire more people. The idea is to turn the engine back on here. But one of the immediate effects, a lot of corporations, not just people with their money market accounts, but corporations as well, have been able to put their cash in T-bills yielding, 5%. And when we're cutting the Fed funds rates, well, what happens to that money? Well, it reduces the fixed income that everyone's been enjoying for a while. And this is, ironically, a deflationary force while they're trying to really, heat things up. It's a piece that I think is important to not ignore. Daily reminders: 2-year, 10-year Treasury yield curve was inverted for over 2 years now, not happening since right before the Great Depression. We recently had reversion of this on September 6th of this month. When you combine that with the fact that the SOM rule has been triggered, showing that the unemployment rate has been going up at an unsustainable pace, that was triggered in July of 2024, this all says that the recession has indeed already started. And with the S&P 500 having a PE ratio of 29 without major earnings contraction, being very expensive, along with, by the way, bond rates being high. If you've been following our discussion on the intelligent investor, if you've moved on to chapter 14, he discusses this explicitly about the yield, the bond yields and how they relate to the PE ratios of companies. Basically, when you have bond yields higher, it makes sense for, as I've said in the show, I've actually not heard him, I haven't come across him directly saying this before reading chapter 14 of this book, but the idea is that, PE ratios can be bigger when bond yields are lower. It makes sense. When a company makes less money, but then the guaranteed rate of return is also less, then that kind of makes sense. But when you have rates high, the 30-year bond yield being around 4% right now, while the S&P 500 has a PE ratio of 29, it's massively expensive. We're setting ourselves up for a major market crash in my strong estimation, and that is my crystal ball reading. And that's how I imagine it may stay for a while until there's more evidence of that piling in. I also believe the Fed will not cut fast enough to save the economy, as I explained earlier in the video. With fiscal dominance, the Fed raising rates doesn't have as much of an effect, and cutting rates doesn't have as much of an effect. In many of the crystal ball gazing recent shows, I've been discussing how, I'm waiting to see if the S&P 500 can get to a closing all-time high, and if that's the case, then, the S&P 500 can continue higher here. But the first cut being right around the corner in September, especially now that we're seeing a 50 basis point cut, what does it say? It says that the market believes, again, that the Fed believes that they're behind on the cuts, suggesting that the Fed sees a slowdown worse than they previously had seen it. And so with that in mind, it would make sense to me now that the bears should be taking over here. I can't really imagine the S&P 500 going higher, but it can. But I need to see a confirmation of that. I need to see a all-time closing high again in order for me to believe that, it's game on again for the stock market, at least for a little bit here. And again, if the market is to rally here, I don't think it will last long. I think this is what they call the wall of worry, climbing the wall of worry. And I don't think it's going to end well. When we have the first cut, take a look at the Fed funds rate. As soon as it goes down, that's usually we're going right into the storm. We're going straight into the recession right now. This is just the part of the cycle that we're in. I talked about in the previous show on Friday how we had just touched this trend line from the all-time high in the NASDAQ, the triple Qs, and how it connected perfectly with this line, and it's just playing out like clockwork, where we are bouncing off of this line, and it looks to me like we are indeed still very much in this pattern that I expect to play out, the head and shoulders top in the NASDAQ. It would make a lot of sense to me to play out this way. I've been talking about it every show recently. I don't always, by the way, talk about the VIX futures curve, but it's still very worth noting. It's very worth paying attention to. The October contract is still elevated past the November and December contract, suggesting that the volatility is coming. This is partly why I currently have puts on HYG, because I believe that that's the best risk reward for speculating as to what may happen here. If we do get major stock market volatility, credit yields will spread. And right now, the high yield corporate bond market is still not seeing any fear here. If you take a look at HYT, we hit again a new high, which is just again continuing to astound me. I talked about on Friday, and I still am gonna agree with my previous stance that, you know, Mr. Market has lost his mind and he's flying down the highway here with a few drops of gas in his tank and something in his water bottle that's not water. I think he's acting a little crazy here. And yeah, put contracts on junk bonds right now are very cheap. They're not worried at all. People that are selling puts and buying junk bonds have zero fear right now. And it's mind-boggling to me that this is what's going on in markets. But hey, if people want to buy junk bonds right now and keep getting the price to go higher, I mean, they can do that. Nothing's, you know, stopping them until, you know, bankruptcies start piling in and these bonds start defaulting. I mean, but we'll see. If you've been following the show, you know that I have over 55% of my own portfolio in long treasury bonds in the funds 0Z and TMF. This is TLT. It's the more popular ETF that holds long bonds, and we're getting very bullish here. You know, we're breaking to new highs. We had the yen carry trade blow up that sent the TLT to the moon and straight back down again, and then we've been climbing up this wall. I've been very curious if we were going to, you know, confirm a bullish market above this previous high, and we are. It's looking bullish. That's all I can say. Like I said earlier in the show, you know, for the value of bonds to be as low as they are compared, you know, considering their yields are pretty high compared to the valuation of the stock market, I mean, okay, one thing that can make stocks make more sense is if bonds go way up in price and the yields go down. That actually makes a PE ratio of 30 make a little bit more sense, but there's a ways to go for yields to drop here for it to really, really make sense. Another market that caught my eye today was XHB, the Home Builders Index, at a closing all-time high today. So I find that to be very interesting. You know, part of this is obviously homes become automatically more affordable if rates are going down. I mean, it's a direct correlation with TLT. So if TLT goes up, then borrowing costs are going down. And so it makes sense for home builders to do well in an environment like this, at least temporarily, until people figure out that, you know, there aren't any buyers left because nobody has enough money, and they're going to have to actually lower the prices of houses, considering that they are higher related to median income than they've ever been. But for now, you know, it makes a little bit of sense for XHB to get a bid here along with treasury bonds. And with confidence in home builders, Wood also got a bid today. I noted on Friday how we hit this same trend line here, and we broke right through it today. So that is interesting. Wood is a pretty decent leading indicator. So this could add some bullishness into the belief of the strength of the economy. You know, this can lead the S&P 500 higher. So it will be very interesting to see how all of this plays out. Fear and Greed Index on CNN, exactly in neutral. I mean, this makes sense right before the FOMC, you know, official announcement and the reaction of everybody. You know, the market's going haywire here. You know, again, this is the first cut. This is the first cut of this whole cycle. It's a very exciting week. Last chart that caught my eye was KWEB, KWEB. You might be familiar with this if you're familiar with the fact that the Amazon of China is very undervalued. When we're talking about JD and Alibaba, they're very, very undervalued, and they're the largest pieces of this KWEB fund. I bring this up only because we've been seeing a very, very tight coiling pattern here, suggesting that we're sort of preparing for a breakout to the upside or to the downside. So be really interesting to see how that plays out. I mean, I would say that it's more likely to go to the upside. When you have rates dropping on the whole curve and the Fed cutting, it weakens the dollar against other currencies, and so that can automatically give emerging markets like China a boost to the valuation of their stocks in terms of dollars. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.